Have you ever wanted to own real estate? Well, don't worry, my friends. In this video, I'm gonna give you the 6 steps to buy your very first rental property. Did you know that 90% of all self-made millionaires have one asset class in common? Well, it's real estate. So why don't you own any real estate? Listen, my friends, real estate is your ticket into the game of money where you can actually win. But if you're thinking about buying your first rental property this year, you might be overwhelmed by the choices. Single family, multifamily, Airbnb, short-term, long-term, the options can be paralyzing. But here's the truth. The most successful real estate investors don't just buy properties, they build a system. In this video, I'm going to show you how to buy your very first rental property using the passive income machine investment system. This is the very same system that I've used to achieve financial freedom, and I've also helped thousands of other people do the exact same thing. Now, if you don't know me, my name is Ryan Lee. I'm a non-traditional financial strategist and a real estate investor. I own over 40 single-family homes and a multi-million-dollar portfolio, all built within the last 10 years, buying a simple type of real estate and repeating that process over and over and over again. And I've done this by not following the crowd, because my friends, the crowd, they're distracted. They're constantly going from the next thing to the next thing to the next thing. But rather than following the crowd, I've built and you're going to build mastery in a simple type of investment philosophy. The system isn't just about buying properties, it's about creating a sustainable flow of passive income that will lead you to financial freedom in 10 years or less. Step number 1 is determining the difference between ownership and syndication. There are 2 ways to approach real estate investing. You can own a property on your own, or you can partner with others through syndication. Ownership of real estate versus syndication is by far the most profitable route to investing in real estate, but it does require more financial intelligence. When you own real estate, you keep all of the upside, all of the cash flow, all of the appreciation. You get the depreciation, you get to experience the amortization, you get to use all forms of leverage all on your own. But it also means you're responsible for understanding the market, managing the property, and optimizing your investment for the best possible outcome. On the other hand, syndication allows you to partner with a professional or a professional set of investors and share the profits with them. Yes, it's a more passive approach, but it comes at the cost of control and leverage. While syndication can be a good option for those who already own a baseline of properties, if you're just starting out, I 100% recommend you go down the pathway of ownership. This way you'll gain the full benefits and experience necessary to truly understand the game of real estate investing. This brings me to step number 2. Now that you've chosen to own real estate versus syndicate, now we have to understand what type of real estate you want to invest in. The truth is actually really simple. Get rich in a niche. If you commit to and double down over and over and over again in a single form of investment, you're going to get better at that niche, you're going to master that niche, and that's what's going to create the wealth that you desire. But let me invite you to consider something. You don't necessarily want to become a real estate expert. Ask yourself this: if you woke up tomorrow and money wasn't the primary driver of the decisions that you're making, would you go out and be a real estate investor for the fun of it, or do you want the benefits that real estate provide but not necessarily want to be the one finding property, rehabbing property, renovating it, and managing a tenant? Most people want the outcome of real estate, not the job of doing real estate. This is where turnkey real estate investing comes in. Turnkey properties are fully renovated homes or apartments that are ready for tenants right now.
Well played.
A professional company handles the finding of the property, the renovation of the property, they manage the tenants, and they do most of the work on your behalf. All you need to do is collect the income and manage the system. I want you to envision yourself as a CEO. In a company, a CEO does not do all the jobs within the company. The CEO manages all the people doing the jobs to get a very specified outcome. This is exactly what turnkey investing is. Turnkey investing allows you to manage a system where someone else does most of the work and you're managing for the outcomes necessary for you to become financially free. The benefit of turnkey investing is that you get to experience true financial freedom because your income is passive. Remember, financial freedom is a function of 2 things. Number 1, it's a function of your cash flow being greater than your expenses. But number 2, most people forget about this. Financial freedom is about your time, owning and controlling your time. If you have a job in real estate, you might make money in real estate, but my friends, I want you to consider you don't own your time, therefore you're not actually financially free. Most people in the game of real estate have simply created another job for themselves in real estate. And the worst part about it is most people with these second jobs already have have a full-time job. If you're watching this channel right now, it's likely you already have a job. You're already a business owner. You're somebody actively pursuing income. And if you're now going to add a part-time job in real estate on top of that, you're going to get further from financial freedom, not closer with every property that you buy. So listen, my friends, if you're finding this content valuable on this channel, I want you to subscribe. Do me a favor, pound that subscribe button, give me a like, comment down below financial freedom, and I'm gonna give you some free tools to help you understand how to buy real estate effectively. The last thing I want you to do, I want you to share this with friends, because friends, they don't let friends retire broke. So give this video a like and share it with your BFF, and let's get on to step number 3. Step number 3 is focusing on single family homes. When it comes to minimizing risk and maximizing upside, single family homes are my top, absolutely favorite recommendation for first-time investors. Here's why. Number one, it's so easy to finance these properties. Banks are more comfortable lending on single-family homes because they are less risky compared to multifamily or commercial properties. Number two, massively low vacancy rates. Single-family homes right now at this time are in such maximum demand, meaning you're less likely to experience long vacancy periods. With lower vacancy rates comes higher profit. Number three, it's simple management. Managing a single tenant in a single-family home is far easier than dealing with multiple tenants in multifamily properties. Plus, if you choose a turnkey solution, the management is taken care of for you. Number four, it has a massively strong resale market. Single family homes tend to have a larger pool of potential buyers, making them easier to sell when the time is right. And if you don't sell, which is ultimately what I recommend, you experience more and more and more upside. As your property appreciates year over year, you gain more of a return on investment simply because you own a simple single family home that goes up in value because of market conditions. By focusing on single family homes, especially in appreciating markets, you can build a solid foundation for your real estate portfolio with lower risk and much higher returns over time. It's not uncommon for someone who owns a single family home, when you add up all of the ways you're making money from appreciation, amortization, tax deductions, leverage, and cash flow, to be earning between a 30 to a 50% return annualized year over year with a simple single family home. Now, this brings me to step number 4. Step number 4 is now where the rubber is going to meet the road. It's about understanding the market that you want to invest in. The first step in buying your first rental property is understanding which market is going to be the best market for you to consider investing in. Real estate investing typically revolves around two strategies: cash flow and appreciation. Cash flow markets are found mostly in the Midwest. I want you to understand that right now in the United States of America, there is a massive migration from the coast inland. Why? Well, because on the coast, the inflation rate, the cost of housing, the cost of living has gone up at such an extraordinary rate that people are looking for a safe haven to at least have a minimum viable lifestyle, and they're coming to the Midwest. These properties are cheap, especially when compared to the properties on the coast, and they offer very high rental yields. However, they come with a little bit of a hidden cost. The appreciation rate in the Midwest isn't quite as high as in other areas. So in a cash flow market, you're going to get high rental income, but not quite as much appreciation, meaning there's not quite as much boom in the value of the real estate because of the market that it's located in. On the flip side of this, there's appreciation markets. I love appreciation markets just as much as I love cash flowing markets. I love to have a combination of both types of properties in my portfolio. An appreciation market is where people are massively migrating to an area, think about Florida, and the value of that real estate is going up at such a level because of the massive demand for a limited supply of real estate. For example, in Michigan alone in 2023, the appreciation that people experienced on a single family home in Detroit was about 25%, meaning all you had to do is own a home and you experienced a 25% tax-free return on just owning a property in an appreciating market. This now brings me to step number 5. Now that you've selected the market that you're going to buy in, you have access to one of the greatest resources and investments as a real estate investor: financing. Do you know that in real estate investing, you're not actually buying the real estate, you're investing in a mortgage? Most people think it's the property that they're buying, and yes, you own the property, but the real asset that you're investing in is a 30-year fixed rate mortgage. I want you to imagine yourself walking into a bank and saying, "Hey bank, I want $150,000 in cash."
No, I don't think so.
They'd probably look at you kind of crazy and show you to the door. But if you ask for $150,000 in cash to buy a house, the conversation changes dramatically. Banks are in the business of lending money to you to invest in real assets. A real asset is something that has real value across time that a bank can use as collateral on a loan. So the loan that the bank is going to give you is called a 30-year fixed rate mortgage. Now here's the best part about this. It's a tax deductible mortgage, which is one of the most powerful financial tools available available to you. It's this access to leverage that makes financial freedom in 10 years or less possible. To secure a good mortgage, to buy your first rental property, you need to ensure the following. Number one, good credit. Aim for a credit score of 700 or higher to qualify for the best rates possible on your 30-year fixed mortgage. Number two, you're gonna need a stable income. Lenders want to see consistent income coming typically from a W-2 job or a well-documented self-employment income. Number three, you're gonna need a down payment. While 20% is standard, there are programs that allow you to put down as little as 3 to 5%, so you can explore options like FHA, VA, or where possible, other creative forms of finance. But I want you to consider this. A bank is your ticket to 80% of the capital that you need to achieve financial freedom. I want you to realize the power in what I just said here. You only need to have 20% of the capital required for you to become financially free. The other 80% of the capital required for your financial freedom is held at the banks. And if you can find the middle ground, a good property to invest in, the banks will bring 80% of the capital required for you to become financially free, and you only have to bring 20. This allows you to go so much faster on your path to financial freedom. My friends, if you can't qualify for a mortgage right now, the answer isn't no, it's how. Consider partnering with someone who can qualify or work on improving your financial profile to get that approval. Access to credit is your ticket to financial freedom in 10 years or less. This now brings me to step number 6, and ultimately I should have started with step number 6 because it's beginning with the end in mind. It's choosing the right exit strategy. And at the end of the day, I believe this is one of the most misunderstood steps in personal finance. Very few people understand how to convert their assets, whether it's a 401k or even real estate, into a stream of income that will make them financially free. So in step number 6, we're gonna choose the right exit strategy. Once you've chosen your market, the next step is deciding what to do with the property. Should you rent it long term? Should you list it on Airbnb or explore other options? My rule of thumb is really pretty simple. Always make sure the property works as a long-term rental first. If it works as a long-term rental, then anything else is possible on top of that. Airbnb can be a great way to maximize cash flow in the short run, but it does come with some risks. Cities change their short-term rental regulations all the time. COVID shut down many of the rental regulations associated with Airbnb. So Airbnb is not a long-term strategy. A long-term strategy is knowing that across time you always have a good asset that is in high demand for long-term rental. Personally, I prefer long-term rental as the foundation of my real estate portfolio. I use turnkey real estate that I can hold over the long run that I know will go up in value, and I can rent out consistently. Over that consistent time of rent, I use the rent to pay off my mortgage, I use the equity in the property to buy more real estate whenever I'm ready to do that, and then I use the cash flow to ensure that I always have money in my bank account to continue to play the game of owning real estate and really managing my personal finances based on the cash flow coming from my assets. When you own a property over time, you get appreciation. Appreciation is when the property increases in value due to inflation or market growth. You get mortgage pay down. Your tenant is paying off your mortgage for you over time, increasing your equity. You get cash flow. Cash flow is when you earn a positive spread of money on the rent that the tenant pays you after it's covered all the costs associated with real estate. And last but not least, probably one of my favorites, you get massive tax benefits. Real estate offers significant tax advantages, including tax-free cash out refinances, depreciation, and tax-free cash flow when it's done right. With real estate, it's massively important that you begin with the end in mind. Ask yourself, why do you want to own real estate? You want to own real estate to be free. So start with that end in mind and buy the right type of property in the right type of system that will allow you to have both income and time. One of the best parts about owning real estate, my friends, is the fact that the economy, the things that hold most people back in the economy, which is inflation and taxes, these two things now work for you rather than against you. Imagine getting wealthy because of inflation rather than getting poor because of inflation. When you put your money in a place like a 401k, what's ultimately happening is you're parking your money in an account and inflation is constantly eroding the value of that account. Even though it looks like your account is going up in value, which it is, the purchasing power of your money is going down. On the flip side of this, when you own real estate, as the cost of living is going up, there's two things working in your favor. The value of real estate is going up, meaning you're getting appreciation. Your fixed rate mortgage is staying stable, so that's actually going down over time because of inflation. And last but not least, you get to slowly, incrementally raise your rents again as the cost of living is going up. What this means is inflation is actually making you money. Look, my friends, the game of money and personal finance is really pretty simple when you look at the big picture. If you watch watched one of my last videos, you know that the government is and will continue to print money. The national debt just crossed $35 trillion, an incomprehensible amount. This has caused massive inflation, and it will continue to cause inflation, destroying most people's retirement plans unless they own real estate as part of their portfolio. Knowing this, the goal of personal finance is really pretty simple. Your objective is to trade fake dollars that you earn at your job or your business for real assets that go up in value over time. This is how the game of money is won. Real estate is the way to use bank money to buy real assets always in demand, and real estate is the way to secure and grow your wealth over a long period of time. Well, my friends, that's it for today. You now have the 6 steps to buy your first or maybe even your next rental property in a more effective way. So let me know in the comments what's holding you back from buying your first property. I'll do my best to answer those comments and give you the insights that you need to take action, because a real empire builder is someone who sees the opportunity amidst the chaos today. So my friends, join me on the next video, and I'll see you then.